Welcome to The Explainer. So today we are digging into the latest earnings report from the healthcare giant Abbott Laboratories. And let me tell you, it's a story with a real twist. We're going to break it all down.
All right, so on January 22nd, 2026, Abbott drops its results and bam, Wall Street reacts immediately, sending the stock tumbling over 10%. Now, a big drop like that, it usually screams bad news all around. But that's not quite the whole story here.
And this is where it gets really interesting. This is the puzzle that sent the stock spinning. See, the company missed its revenue targets, but at the exact same time, it perfectly met its profit goals. So wait a minute, how does that even work? How can you miss on sales but still hit your profit target? What is really going on inside this healthcare giant? Okay, let's get into it. We're going to unpack that report card that caused all the confusion. Then we'll get into the two competing stories inside the company. You've got one of struggle and one of major success. After that, we'll look at Abbott's huge bet on the future. And finally, we'll see what this all means for the year ahead.
All right, Section 1, the Q4 report card. A real mixed bag. So let's start right at the top with the numbers from the fourth quarter of 2025. Because honestly, this is where all that confusion on Wall Street started.
So as you can see, they brought in about $340 million less in sales than the experts were expecting. I mean, that's a clear miss. But their profit per share? It was right on the money at $1.50. It's this disconnect that really tells the tale of two completely different stories playing out inside Abbott's business, pulling it in opposite directions.
Okay, moving on to Section 2, nutrition's pricing problem, the struggle. Let's start with the part of the business that's, well, struggling. We're talking about their consumer nutrition segment. You know, the part that makes products like Ensure. This is the division that's responsible for that big revenue mess.
You know, the CEO, Robert Ford, he laid it out pretty clearly on the investor call. He said they're kind of caught in this tough cycle. Manufacturing costs shot up, so they had to raise prices to protect their profit margins. But now, well, those higher prices are scaring away customers who are watching their wallets, and that's causing sales to drop. So what's the plan to fix this? Well, it's a two-pronged attack. First, they're going to play with pricing and promotions to try and win back those customers. And second, they're launching a whole wave of new stuff, at least 8 new products, to get people excited again. Now, they're being realistic. They expect the first half of 2026 to be pretty challenging, but they're betting this plan will get things growing again in the back half of the year. Okay, Section 3, the medical device powerhouse. And this is a story of a major surge. So let's switch gears and look at the other side of the Abbott story. Because while that nutrition business is struggling, their high-tech medical device business isn't just growing, it is absolutely surging. I mean, look at this. This division, the one making everything from heart valves to pacemakers, it grew by an incredible 10.5% in just the fourth quarter. This is the engine that powered the whole company, allowing them to hit those profit targets even with the trouble in the nutrition department.
And get this, it wasn't just one lucky product. The growth was strong right across the board. We're talking diabetes care, electrophysiology, structural heart, you name it. It really shows just how deep and powerful this part of their business is.
But even with all that success, there's one single product line that has become an absolute blockbuster for them. I mean, it's driving a huge chunk of the division's growth. We're talking about their continuous glucose monitors, or CGMs. These things brought in over $7.5 billion in 2025 alone. That's just phenomenal, and it's all fueled by this massive global shift towards preventative care and, unfortunately, rising diabetes rates. To put that number into perspective for you, that single product line is bigger than many entire companies out there. Just incredible. All right, let's move on to diagnostics and pharma, the supporting cast. To really round out the picture here, we've got to look at the other two divisions. Think of them as the solid supporting cast in this whole story. So yeah, these guys played a key supporting role. Diagnostic sales were down just a bit, which, makes sense as COVID testing winds down. But the real story there is the momentum they're building in their core lab business. That's a huge area for them going forward. And then you've got their established pharmaceuticals business, which was just a steady, reliable anchor, growing a solid 7%, mostly thanks to strong performance overseas. Okay, Section 5, Abbott's big cancer bet. This is their future play. And this brings us to a really big move Abbott is making to lock in future growth. They're looking beyond the daily push and pull of their current businesses.
So the big question for them is, with the consumer business in a bit of a funk, where does that next big wave of growth come from? I mean, they're clearly looking for their next big thing, right? Something on the same scale as their medical device success. They know they can't just ride the CGM wave forever.
And here's their answer. It's a huge acquisition. They are buying a company called Exact Sciences to jump headfirst into the super fast-growing cancer diagnostics market. And listen, this is no small move. This deal brings in a business that's already doing over $3 billion in sales and is growing at a whopping 15% a year. This is Abbott's massive bet on where healthcare is going next.
Section 6, the road ahead. Let's talk guidance for 2026. So after you weigh all this stuff, the struggle in nutrition, the massive surge in devices, and now this huge bet on cancer, what does Abbott actually think 2026 is going to look like?
Now, before we jump into their forecast, let's do a real quick definition of EPS, or earnings per share. It sounds complicated, but it's not. It's just a company's total profit divided by the number of shares it has out there. It's a super important number that tells you how healthy and profitable a company is.
Okay, so here's their official outlook for 2026. They're projecting solid sales growth, right around 7%. But what's even more important is they expect their earnings, their profit, to grow even faster at 10%. That tells you they're really confident that the booming parts of their business are going to more than make up for any of the challenges.
So what's the big takeaway here? It's that Abbott is really a company of contrasts right now. It's a company in transition. On one hand, they're managing a short-term problem with their consumer business, but on the other, they are riding this massive long-term wave in medical technology. And their CEO, Robert Ford, he's projecting total confidence. He's basically saying, look, our new product pipeline is a fire hose of innovation. He's betting that combined with huge strategic moves like buying Exact Sciences, they are perfectly positioned to accelerate their growth in 2026. And all of this leaves us with one big final question. Right now, Abbott is managing two totally different stories, a consumer slump and a medtech boom. But is their huge bet on cancer the thing that will actually define their next decade? While they're navigating today's challenges, their entire future might just be written by this bold move into a brand new market. I guess only time will tell if that bet really pays off.